Hello, everyone. Thank you for joining us today for our 2021 Oil and Gas Outlook, a focus on digital infrastructure. My name is Lori Jamail. I'm a Senior Marketing Manager with Weaver, and I'll be here throughout the webinar to support you with any questions. Before we get started, I want to run through a few logistics. You are joined today in listen-only mode, which means your microphone is on mute. We do want your participation. If you have questions, please type them in the question area and we will address them through the presentation as well as at the end. If for some reason we don't get to your question in due time, our speakers' emails are included in the slides and we can reach out to us directly to talk offline. Also, a copy of today's presentation will be located in our handout section of your Zoom control panel, and a recording of our webinar will be accessible on weaver.com in just a few days. If you are participating today for CPE, please make sure you answer our polling questions throughout the webinar and remain active for at least 50 minutes. Additionally, you will be asked to complete an evaluation survey at the end of our event, and CPE certificates will be emailed within a week. Now that we have the logistics out of the way, we're ready to begin. We're thrilled to have a robust group of industry leaders joining us, and I am happy to pass the microphone to Brian Thomas, our partner and national practice leader of advisory services.
Thanks, Lori. As Lori said, my name is Brian Thomas. I'm actually the national practice leader for our advisory services, and I'll be your moderator today. My first introduction is for a man who doesn't need much of an introduction in this industry, Dan Pickering, founder of Pickering Energy Partners, which combined with Tudor Capital in 2007. In a few moments, Dan is going to give us an overview of the outlook for the oil economy. My next introduction is for Elisa Martin, who is one of my partners here at Weaver. She's our national strategy leader for large markets. Elisa has provided a wide array of consulting services to clients in the oil and gas industry her entire career. And last but not least, I'd like to introduce Brandon Elam, Senior Vice President of Accounting Solutions at P2. Brandon has also served the industry his entire career implementing and developing various technology solutions for clients in the energy sector. With all of this expertise, I'm very excited to hear what our panelists have to say about today's subject, which is the outlook for oil and gas in this crazy market that we've all been operating in for some time now, and why it's time to focus on your digital infrastructure. And with that, I'm going to turn this over to Dan, who's going to give us a brief overview of what's going on in the oil economy. Dan?
Great. Thanks, Brian, and thanks to you and Weaver and the folks at P2 for having me involved. Title of my talk today, Coming Out of the Chasm. It has been a tough and long downturn in the oil patch. And the good news is things are getting better. And I'll talk through that in the next 15 or 20 minutes or so. But I think if you have one takeaway, it's that there are cycles in the energy business, and we've been in a down cycle. It's the worst down cycle since the call it late 70s to mid 80s. It's been a tough one, but I think the bottom is in, and we're coming out of it. Let's go to the next slide. This is just a little bit about us at Pickering Energy Partners. Welcome to check us out on our website. We invest in public and private energy companies. We do consulting for the energy sector, and we actually have an electric vehicle charging business that we started last year, kind of surfing the wave of the energy transition. So we're excited to be participating here today and telling you about how we see the world going forward. On the next slide, what you'll see is just mechanically or mathematically what's happened over the past few years, and showing energy and energy prices and energy stocks and energy activity from year-end 17, 18, 19. Really, things were quite tough until the last part of 2020. And since that bounce in October of 2020, what you can see is energy has been very strong, kind of coming off the bottom. Rig count down here at the bottom of the slide, rig count is up 35%. Permian rig count, Permian's the biggest play in North America, up almost 60%. Energy stocks up 70%. Natural gas is the only piece of the puzzle here that hasn't improved. It's down a little bit, but oil's up 65%, and that's dramatically outpacing what's been a very good run for the stock market since last October, up 25% or so. So energy is kind of coming off the bottom, and as industries typically do, it's bounced quite hard. If we look at the next slide, the question becomes, what do we need to trust to believe that this is a recovery as opposed to a head fake. And so I talk here about the 4 pillars of what kind of the current or next, depending on if you think we've made the bottom, I do. But what are the pillars that we need to believe that say things continue to get better? And those things are the world can't get worse with COVID again. You've got to believe the economy is picking up and the COVID is going to recover. You got to believe that the industry that's showing good capital discipline will continue to show that. You have to believe that investors aren't going to throw money at the sector again with sort of drunken sailor type of enthusiasm like they did to fuel the last boom. And then you have to believe that those things combine to make oil prices good. So I'm going to show you on the next slides, how I think these 4, let's go back for 1 second just to hit. So I'm going to show you as we move ahead, I'm going to show you these 4 things. I think the thing that scares people right now, the biggest fears out there are that energy demand, oil demand in particular, is going to peak. I'll talk a little bit about that. And then there's a lot of confusion over the energy transition and this shift to a low carbon future and what that means for the oil and gas business. So those are the overhangs. I think we've got these 4 pillars. I'll talk about all that as we move ahead. So let's go ahead to the next slide. So in terms of believing the world's getting better, I'm using some information here from a brokerage firm called Evercore ISI. They do great work on the economy, and what you can see is money is pouring into the economy dramatically. This is the fiscal stimulus coming from the Federal Reserve balance sheet. Interest rates have ticked up, but they're still very low. Company surveys, these guys go out and ask companies about what's happening. You can see that the economic expectations via these surveys are as high as they've been in a decade coming out of COVID. And the Purchasing Manager Index is also, as high as it's been in 10 years. So I look at those things and say the economy is absolutely getting better. Inflation is on the way from my perspective. And, the bottom right here of this slide shows Uncle Sam kicking the can. We are going to have to pay for this at some point in time. Higher taxes are already being discussed. So there's a payback that's going to have to happen, but the payback's probably far enough in the future that we think right now the economy is recovering. Let's go to the next page. So I said investor capital discipline is going to be important. When we look back to the shale boom, there was very much a growth mentality. Debt was cheap, equity was cheap. When things got tough in 2016, a lot of money poured in and supported the shale assets. And what we wound up with is oversupply on a global basis and a lot of tears. This downturn started in 2014 has been very tough, a huge number of bankruptcies. So the growth mentality got us in trouble. What's the current mentality? 6 years of a tough market has made debt harder to get. It's made equity harder to get. It's resulted in capital providers leaving the business, whether that's shrinking private equity or reserve-backed lenders that are no longer lending. So there are fewer capital providers, and so with less supply of money, the return expectations have gone up, and investors generally want more cash back from the companies. Instead of saying drill wells, they're saying pay me a dividend. So that mentality, I think, is very important to control the supply side of the equation. The industry will spend as much money as they can get, and they can't get as much, so they're more disciplined. Let's look at the next slide. What this shows is investors are actually punishing companies that are trying to raise capital or that are out there needing to access capital. I'm just showing you a number of data points where companies that have tried to IPO or do a convert, which is essentially a way of raising equity on a convertible basis. Those stocks have underperformed their peer indices. Liberty Oilfield Services, an oilfield service company, brought new stock and has underperformed by 20%. EOG is a great company, but it's been much more growth oriented than its peers and has underperformed its peers meaningfully. The only 2 companies that have gotten the pass have been Magnolia and Matador. but I'd say generally, if you are a spender or a capital seeker, it has been very expensive or relatively painful to be in the market. So the investors are reinforcing this capital discipline issue that I think is real important. So let's look at the next page, which is the third pillar that I talked about, was that we need industry to be capital disciplined as well. And so if we think about what's happened over the last, call it couple of years, we've seen OPEC sending a very loud message that they're not going to give up market share. That was what kicked off the big crude correction in 2020. Wall Street sending that message, I just showed you that. And so the companies have been repairing their balance sheets. They had, the ones that didn't go broke had a near-death experience. And so when you have that, you fix your balance sheet so you don't run the risk of having a debt problem going forward. And folks have adjusted their cost structure, which will be a topic for later today from the panel. So all of those things have been ongoing. And then you've hedged production because you're afraid that things might stay bad. And so this big run in crude price that we've seen, companies haven't necessarily gotten all of that money because they've hedged some of their production. And I'd argue there hasn't really been a great price signal to the industry yet. I'll show you that in a few slides. And then finally, the energy companies themselves, they've got a challenge in that everybody's asking them what they're going to do in the energy transition. And so, there's hundreds of millions and billions of dollars being diverted from traditional oil and gas spending to ESG spending. And so that's pulling capital away and keeping the industry, from spending as much as they might otherwise spend on drilling. And so the net effect of this, if you look on the right-hand side of the page, is that spending on a global basis is as low as it's been in over a decade, and probably 15 years. And so the industry's gotten the message. It's been ingrained in them: pay down debt, issue dividends, find a way to generate free cash at $45 or $50 a barrel. And so, the industry right now is being quite disciplined. Let's look at the next page. When we advance the slide here, you can see that U.S. rig count, it's up, but it's at very low levels compared to where it was in 2014 or 2015. So, if the benchmark is 2014, rig count outside the Permian is down about 80%, and in the Permian it's down about 50%. And so activity is low. And one of the reasons that activity is low, if we look to page 14 here on the slide deck, is that while the current oil price has had a nice pop, it was 55, it bounced all the way to 65, and today is trading at 59.5. If you look at the forward strip, which is the future expectation of prices, what you can see is that oil prices are actually steeply backwardated. And if you're thinking about hedging production out in 23, 24, 25, you're getting low 50s. That is not a great number. And so the curve has not incentivized people to really step up and spend and drill yet. Let's go to the next page. Here, I'm just trying to show you how I think the market's going to find equilibrium. If we go back to 2019, pre-COVID, the world had about 102 million barrels a day of supply. That's the far left-hand side of this chart. It was 100 million barrels a day of production and about 2 million barrels a day that OPEC had curtailed. We look at the right-hand side, we were a pretty balanced market. Demand was about 100 million barrels a day. If we look at where we think we'll be in 2021, our best guess is that gasoline demand on a global basis will be down about 5% or so. Currently, it's down about 9%. We expect the back half of the year to be much better. That's about 2.5 million barrels a day of lost demand. And then if you look at jet fuel, that's an 8 million barrel a day market that we think will be down about 30%. Right now, it's down about 30%. And so that tells us that 95 million barrels a day will be equilibrium. And, the Energy Information Administration thinks it's 96.5. 6 months ago, their number was 98 and my number was 93. We're meeting in the middle here. But we've got a market that's down about 5% from where it was in 2019. And what that means is we're going to need OPEC to hold maybe 2 million barrels a day off the market, and they're currently at about 7.9. So OPEC will be coming back. Let's take a look at the next page. So what we saw when things were bad is inventory blew out. That dark blue line is where inventory was during 2020. It was the highest levels that we'd seen in decades. And so you got to fix an inventory problem before price can get better. But look at the dashed line. The dashed line is where we'll be if OPEC continues to hold barrels off of the market for the full year. So we're going to need them in the second half of 2021. Let's go to the next page. And so talking about OPEC, the interesting thing is with 8 million barrels a day off the market, this is a really big hammer. If they brought it all back at once, oil price would go down a lot. And so there's this circularity where U.S. shale's afraid to spend because what if OPEC comes back in and tanks the market? And they've shown that they will use the spare barrels as a weapon back in 2020. So OPEC's being supportive. They've got this big hammer. They're going to have to come back over time because we're going to need those barrels, as I showed with the inventory chart before. And so, you know, they've got to ease back in. They're doing it, I think, pretty well so far. But this is another thing that's reinforcing this capital discipline. Let's go to the next page. So if we recap where we're at in this discussion, you know, I said the 4 pillars where the economy's got to get better. I think it is. The industry has to be disciplined. I think it is. That investors have to be disciplined. I think it is. And oil price takes care of itself if those first 3 pillars hold. So what are the things that we worry about? Right now, everybody's scared to death that we're going to stop using oil. This graph just shows what oil demand has done over the last 50 years. And it's grown, and it's grown at varying rates. You know, the 2010 to 2020 time period only 1% per year. But over the last 50 years, it's been about 1% a year. At some point in time, the world will slow down and we'll hit peak demand. Folks are saying, you know, BP says it's 2019. It's already happened. Rystad and the IEA and others think 2030s. I'm kind of in that 2035 to 2045 category, but that's still a long way away. And oil demand is not going to go from 100 million barrels a day to 50 million barrels a day in a year. It's going to be a very, very long glide path. So it's a boogeyman, but I think it's a boogeyman that people are overly afraid of right now. Let's look at page 19. The other thing that scares people that I talked about was the energy transition. So I think we are past the tipping point in terms of thinking about a low carbon future. And why? Because the public wants it. Investors want it. The biggest investors in the world are talking about ESG issues and lower carbon. And corporations are way, way ahead of regulations in terms of adapting net carbon neutrality goals or zero carbon goals. And so you've got basically a huge constituency that wants lower carbon. The government, in terms of the Biden administration, is going to support that with a number of initiatives we expect. And so you have a lot going on around the likelihood of lower carbon over time. But there's a reason people talk about energy transition. This is not going to happen overnight. It can't. The Paris Accord, which is the highest visibility carbon thing, talks about goals for 2050. Now, the last time I checked, that's almost 30 years away. It takes a huge change, and it's going to take a long period of time. And so our view on this whole issue is there's no question that energy companies are going to have to evaluate where they're at in the lower carbon world. They're going to talk about it at the board level. I think there's a risk that everybody does what everybody else does, and that may not fit for a specific company. Status quo may be the right answer for some, but this is an issue everybody's going to have to think about. So I'm not trying to minimize it, but I just think it's a very long-dated issue. So the overhangs here of peak demand and energy transition, both of them are long-dated issues, and I think we have a pretty good cycle in front of us in the near term. Let's look at the next page. So this is sort of, I show this toward the end of my talk because it's been bad, but it can be good. So I started with this climbing out of the abyss discussion. I'm showing you the, kind of how things have gone. The S&P is up 25%, energy prices are up 60%, and energy stocks are up 100% over the last year. Still down a ton from where they were, but up a bunch. If all these four pillars hold, there is more of this in store, in my opinion. Go to this last page. And I finish with this. Anytime I'm talking to an audience that potentially has industry folks in it and investors in it, I finish with this thought of investors in the industry have to stay disciplined. We got undisciplined, money flowed in, drilling activity was huge, and bad things happened. So we are in the repair part of the cycle now. And so value in the past has been defined as, well, I'm going to grow a lot. Well, the reality is that's not what we need right now. What we need are companies that have low levels of debt, good dividend yields, and good free cash. And if companies do this, investors do this, sorry about that, my phone's ringing naturally. So if that happens, then cash flow will go up. Some more of it will go back to the shareholders. They're thinking about consolidation. We do all these things and go slower in terms of the ramp, then I think everybody wins. And so, that's my conclusion, is value over volume for the next 2 or 3 years. And we have a really interesting and I think very profitable period ahead of us coming out of what's been a really challenging environment. So I think there'll be time for Q&A later. At this point, that concludes my talk, and I'm going to hand it back over to Lori, who's going to take us through our first polling question.
Thank you so much, Dan. Very, very good information. Our first polling question: what efforts has your company undertaken to save on cost? And you can check all that apply. Have you been doing some contract renegotiations with your vendors? Are you looking at property divestitures, equipment sales, reduction of office space, headcount reduction, implementation of new information technology, or have you got some other cost-saving measures that you're working on? And we'll give everybody a few minutes to respond. And with that, I'm going to pass back to Brian as our moderator.
Thanks, Lori. Yeah, so just looking at these results, I think this is probably fairly common. Seeing that 60% are reporting that they've done renegotiations with contractors, headcount reduction. The technology spend is interesting to see, and we're going to talk some more about that kind of stuff. But these are measures I think that people both within the industry and outside of the industry have probably been taking to try to navigate this storm, obviously, of the pandemic. With that said, we're going to focus for a few minutes here on direct cost savings, and I wanted to pivot first to Brandon to ask Brandon a few questions, or a question here. So, Brandon, how have P2's upstream oil and gas customers been leveraging P2 products and cloud offerings to reduce costs in 2021?
Well, first, I want to acknowledge the complexity of running an oil and gas company. You have to acquire and maintain land leases, employ an army of analysts, legal staff to make sure it's correct and accurate. You got to pay for those leases. You have to drill new wells, maintain those wells, maintain the production, haul or transport that production to market, sell it, collect the revenue on it. And then you've got to pay your royalty interests. You got to pay your joint interests. And then somewhere down the way, if you've done it in a cost-efficient way, you make a little bit of money. And it can be really frustrating sometimes to see media types or talking heads oversimplify or minimize this. Minimize what you do to bring energy into people's homes and into people's lives. So first and foremost, I want to say thank you. Thank you for what you do. And P2 wants to help in some way. The way we look at it is that complexity presents an opportunity for us to create technology that will streamline certain tasks. We use mobile technology and analytics to bring data to the field, to reduce downtime, or to anticipate upcoming tasks like, hey, this tank's about to be full, it's time to haul it. We use geolocation and analytics to maintain by exception and modify routes in real time. We'll look to automate lengthy manual processes like run ticket management. We'll use workflow technology, to automate certain simple tasks like approvals, for instance, manual journal entries, mapping technology and data, to visualize multiple layers of ownership and assets on a map. We'll bring outside resources and your project teams together, for instance, brokers and lease analysts working together on a project. Streamline paper or document-based processes, tracking and approving ownership changes, for instance, or streamlining updates to large volumes of data, for instance, ownership decks, using global components, global contracts, special owner pricing to maintain large volume decks. We also look at the entire operation and seek to connect it end to end and share what we call master data across the operation. That all the domains, land, accounting, and production use. These are lease information, ownership information, wells, cost centers, production volumes, and bringing that together drives data sharing and visualization for performance management and decision support. But besides that, besides providing software to do that, we also help our customers achieve raw IT savings through our cloud offerings. I actually started our cloud business in 2013, and we did some hosting before that, but really organized it then. At that time, most of our customers were on premise. You fast forward to 2021, and most of our customers actually utilize our cloud offerings. And the reason for that is there's just efficiencies and cost savings to be gained by using a large shared team. So we have 350 customers that we serve to, and it's one team. Now, it's a large team, but it's one team, and our customers are taking advantage of that. That team is doing management of the applications, so you're not training people to do that. We already know how to do it. It is our software. Change management and audit, we partner with Weaver to do that. Hardware procurement and replacement and planning, and disaster recovery planning, for instance. And that is one thing that you're talking to customers that many of our customers in the past did not do, because it's expensive and you're not sure you're going to use it, but it's one of those things, if you need it, you really, really need it. And that's something, through a shared team and through shared infrastructure that we can provide and do it at a low cost. And then the last is business process outsourcing. We have an accounting outsourcing operation, and it's very similar to our cloud offering. We serve a number of customers and do their accounting processes and operations for them. And it's the same thing. It's taking advantage of one shared team and the cost efficiencies that you can gain from that.
Elisa, what direct cost savings have you been seeing with your oil and gas clients over the past year, and how have those been realized?
Well, first and foremost, I'd say, Brandon, you mentioned many different technology offerings that allow companies to scale down, and many of the cost savings have been realized through technology. But Dan, you mentioned that cost reduction was a necessary requirement to get through these last couple of years. And cost savings have been an important factor of survivability. So primarily, we're seeing cutting costs, which isn't helpful, and scaling down of operations to right fit the operations for 12 to 24 months. And I say that 12 to 24 months with an important time span in place, because you have to be careful not to cut costs so much that you ruin or lose the ability to produce and even expand and continue to grow as we're seeing the pricing come back up and some of the operations become more economic. And so preserving that investment of talent or technology is a priority, and trying to reduce and replace the less valuable requirements that happen within the people, the process, and the technology in an organization. And it really is all three of those. It's people, process, and technology. But for cost savings in particular, debt restructure, we all started out with debt restructure. Interest rates might be low, but you still have to have cash flow for debt service, right? Contract negotiations and of all kinds, paying out existing firm commitments or deferring firm commitments for transportation and other requirements. We've seen some property exchanges. That wasn't high on our polling question, but certainly property exchanges better than property divestitures. And then
finding a way to increase cash flow. The sale of commercial paper or warrants, the sale of bonds to increase some cash flow, knowing that the curve will come back. And then employee changes, employee reductions have definitely happened. They've had to happen, and reliance on technology has been the cost savings effort to deal with those requirements that where the people are not there. But also outsourcing. And Brandon, you mentioned outsourcing. I've seen a reduction in outsourcing, so bringing in and insourcing activities that are on a smaller scale or a much shorter scope to the existing population of employees. But I've also seen some really good outsourcing of things like accounting or revenue or JIB for the scaled down operation. And so I think one of the questions that I would have for us today is when you do rely on technology and when you do say outsource some of the accounting or other functions, how scalable is it as we are now in a position to look forward and building back up the operations in a meaningful way? I think it's just important that as these cost-cutting efforts have come into play, that you think forward about what do we do when the necessity revives. And relying on technology is a great way to increase the nimbleness of the operations and to build back the scalability of the operations, whether up or down. And hopefully now, and Dan, based on your discussion, hopefully now we're looking at scaling back up hastily, of course, but taking it and scaling back up without adding a lot more cost to the operations as we continue in the next throughout the next 2021 year.
Lisa, I'm glad you mentioned outsourcing versus insourcing. We're seeing the same thing. We're seeing partial outsourcing and partial insourcing, and I think the key there is companies are focusing on their core competencies or what they do really, really well. And the things that they don't do really, really well, they're going and outsourcing those. And even within our outsourcing, we do partial outsourcing. We may just do revenue, we may just do JIB, or we may just do own relations. But I think that's the key thing there is looking across your organization saying, we do this great, or we want to focus on this, we'll let someone else handle that.
Right. And being strategic about the use of the resources, and again, all resources, including capital.
Well, we've talked about, cost cutting and needing to, I guess, right size our spend given the environment in remaining disciplined. But we've also talked about that cost cutting has an impact potentially to our ability to produce and therefore supply over the near to medium term. So Dan, I was just kind of curious if you could give us your perspective on what that impact is to supply from cuts to investment that have been made over the past couple of years. And then when should we start to see investment rebound? We talk about being disciplined. What does that start to look like in a more disciplined environment?
Yeah. So when you're worried about failing, you do whatever you can to stay alive. And that's what companies have been doing. And as we've talked about here on the panel, part of that is cost cutting, part of that is technology, et cetera. You do whatever you need to do. And I think human nature reinforced right now, human nature for the industry plus reinforced by the capital markets is a slow, cautious return. And so what that says is if you wanted to go fast, you probably couldn't because you probably cut to the point where we couldn't go back to the activity levels or the spend levels that we saw 3 or 4 or 5 years ago because the people aren't there and the processes aren't there. So I think that the combination of the capital discipline issues and the actual capabilities say it takes a little while. First, you got to believe it. Then you got to say, okay, I'll put my toe in the water. And where you eventually wind up in a cycle is everybody's enthusiastic again. But that's going to take 5 years or 6 years, even if oil prices stay 60, 70. So when is investment going to come back? I think it comes back in some in 22, some in 23 supply. I think supply in the U.S., any meaningful supply is 23 or 24. So I think we'll have some time to build our companies back up. but we need that time. The industry needs that time to heal, if you will. And the question is, can we pull folks back in? You know, we've laid off a bunch of people and they're doing different things. And our industry has got to work on its image and attracting new people as well, because it is much harder to, you know, we invest in oil and gas companies, and when we talk to young people about joining our team as investors, which is kind of a sexy business, but they'd much rather invest in energy transition. They'd much rather invest in windmills or solar or whatnot. I'm not saying that's bad. I'm just saying for the traditional business, we've also got to find a way to get people back. So all of those things say supply is 2 or 3 years away. Bye.
Thanks, Dan.
Sure.
Lori, I think we're going to transition now to our next polling question.
Great. Let's pull it up. So to what degree has your company been engaged in business process streamlining over the past 12 to 8 months? Have you done no streamlining at all, some informal streamlining, formal efforts to redesign certain processes, or have you done a full end-to-end business process reengineering? We'll give everybody a few seconds to respond there.
That's good to see. I mean, it looks like most participants are saying that they've done at least some level of streamlining of their business processes, which makes sense. I mean, when you have fewer people and you're trying to cut costs, you're looking to find ways to do things more efficiently and therefore redesigning some of your processes. Doesn't look like very many respondents are on either end of the extreme there with no streamlining or full end-to-end business process reengineering. And part of building a resilient organization involves removing inefficiencies in processes. So we really want to spend a few minutes here talking about process automation and how to streamline while trying to maintain, you know, your system of internal control and so forth. You know, you can only cut so far before you start to run into issues where you kind of have the Wild West in terms of executing processes. So Elisa, what are some of the key considerations you advise clients on when they're looking to streamline their processes? And what are some of the ways you're seeing clients leverage technology solutions to achieve those objectives?
That's a great question, obviously. But with the polling results, it's kind of interesting that, you know, the informal streamlining almost speaks to the have to, right? You have reduced workforces, you have reduced scale of operations, you kind of have to. And so if we focus on what streamlining really is, it's about doing the same thing, but in a more efficient, more direct manner. And that's how we look at the processes. Certainly, Brian, you're right. We have to maintain the internal controls. We've got to preserve the integrity of the processes and the procedures and the controls that were built when we were a larger scale organization, but that can be more efficient. First and foremost, I think we look at, you know, things like key spreadsheets, look for duplication of effort, look for anything that has an RE in front of it, rework, review, re-enter, anything that has duplication in it, and evaluate why you're doing those steps and could those steps be automated. But the why is an important factor. Also recognizing the duration of time from initiation to reporting. And evaluating how many touches you have. We used to call that activity-based costing back in the day. How much resource are you using for that particular transaction to get from initiation to reporting, and what is the speed of that processing? In streamlined organizations and streamlined operations that truly can be scalable and continue to be paced up, as Dan said, hopefully it doesn't take 5 years, but be paced back up into higher volumes, we need to rely on technology. And a great place to look at technology is your existing platforms. You know, your existing ERP technology platform most likely has functionality that has not been adapted, that the functionality is available, and especially if you're in a system like P2 that continues to upgrade and add functionality to the existing install base. And then evaluating what functionality exists, how can you match the manual procedures that are happening with the technology that is available from a workflow standpoint, and really try to automate the low value tasks. Now that sounds, really easy. We're going to automate low value tasks. You have to have the tools to automate the low value tasks. And if you've got an older core application, then you may have to upgrade that core application. Maybe this is your opportunity in a scaled down environment to move to a cloud solution that is managed for you, where the application enhancements come and are delivered more consistently to you. Or maybe you have an opportunity to take something like a RPA application layer on top and build some bots. We've had a lot of clients build bots, and if you don't know what a bot is, it's just a script that performs repetitive tasks. It sounds really hard, but it's not. And it's very much like a batch process back in the old DOS days, but it is identifying the required steps. And these things can be anything from entry into the invoice entry, or the invoice moving to open invoice for your vendor managed activities, or the application of cash receipts, the comparison of your revenue decks to your owner decks and validating those, entering purchaser IDs and creating vendor IDs. So a lot of times we see the bot activity, whether you use a bot or you're just streamlining the application or streamlining your process and using application embedded natural process automation, then we see that in your treasury function. We see it in the revenue and JIB function. We see it in good old-fashioned purchasing and accounts payable, in payroll, and in the treasury process for your bank account activities. And I'm sure, Brandon, your systems have functionality to automate all of those things I just mentioned, right?
That's correct. I love the phrase activity-based costing. When you start using it, we see lots of activity-based costing out there. And just as you said, we see some activity-based costing in certain processes that we actually have in our product. The customers have our product and they're not using. There is a lot of that too. And we try to reach out to our customers and talk about those things. And customers reach out to us and ask us as well. And then there's a lot of activity-based costing that we haven't addressed yet. And just looking across your oil and gas operation, there's really no way to isolate certain functions. Lane ownership, production, revenue, JIB accounting, they eventually all come crashing together. I talked a little bit about integrating these domains through software, so we do that. And another way is to build fit for purpose software. As a software vendor, that's what we do, but this takes time. There are certain complex processes that require heavy investment and years of work and testing to get to you. That's something that we focus on to provide value. However, one question we ask ourselves a lot is, how can we automate simple processes and get it into the hands of our customers quickly in a matter of weeks? And so we utilize workflow technology and RPA technology, as Elisa pointed out, to do this. Processes that are good for this, that we try to tackle, anything that requires multiple handoffs, anything that has multiple levels of review and approval, or organizing information or documents into a repository of some sort and reviewing those, multiple levels of communication, et cetera. So as I'm going through this, take a minute and just think about your organization and do you have any manual processes that really fit into that category? And I bet you're thinking of something right now, or probably many. So we built a product called P2 Workflow, and it leverages workflow technology. It's interesting. It provides you a graphic interface, and everybody, I think, in grade school learned how to draw process flows. And that's what you do. In the graphic interface, you draw a process flow of your process. You can add in web or mobile enabled screens for data entry or approvals and things like that. You can put in automated thresholds for approval, especially if you have multiple layers and you want it to swiftly go through at certain levels. Storage for documents and artifacts of the process, multiple email notifications along the way. it's actually a really interesting technology and fairly new. So as you're thinking about, those processes in your organization that, that you can streamline, and certainly that you can reach out to us and ask us to help you streamline, I'll give you a few examples. So material transfers. We had one customer reduce their time by 50%.
Wow.
So basically they were taking an asset, info on a ticket, paper ticket, entering it into a spreadsheet, and then sending it to accounting who would enter it. And that is just ripe for data issues. And really, really hard to keep everything organized. Using this workflow technology, they're now using a mobile device. They select the inventory to be transferred, they route it for approvals, and then automatically post it to their GL. And it's been a huge cost savings. Another one is manual journal entries. We had another customer reduce their time by 15 minutes per JE by automating the approval process. And you think, well, that's not a lot of time. It is a lot of time when you're doing hundreds or thousands of these, and you're spending less time hunting down approvals and more time doing higher analysis and decision support. We are looking into ownership change. We're actually working on that right now. Tons of opportunity there. You're collecting all the documents that are required for that, routing the approvals, processing the PPAs, sending out the DOs to new owners, notifying the parties. There's so many opportunities there for that. And we're just cutting off bits and pieces and building workflows for that. But I think the thing that gets me most excited is the customers that have adopted this workflow technology. They are jumping in head first, and they're starting to build their own in the user interface. And certainly we can help, and we will if we get asked. But we really want to put it in the hands of our customers to do it on their own. Because there's just so many things out there that they know best. They know how they operate best. They know where they can do something really quickly as long as they understand the workflow tool.
And Brandon, I want to add to that just for a second, because I mentioned evaluating spreadsheets, and then you said we replaced the spreadsheet with the workflow. The more we can encourage the individuals who own that process or step to do it on their own, the more they'll recognize that the application is just as easy as throwing the data into Excel and putting it into Excel, because that's just what they know.
That's right. I always tell people, you're always going to have to learn a tool. And yes, everybody knows Excel, so that's easier, but you had to learn it at some point. And if you have a new hire straight out of college, they may not know how to use that. You'd be surprised, actually, how many people don't know how to use Excel right out of college. But yes, you always have to learn a tool.
All right, guys. Well, we're going to pivot to our last bit of content here. We wanted to focus a little bit on corporate performance management and our final polling question.
All right, let's get that polling question up super fast. I know we are coming on the top of the hour quickly. So how adequate are the reports your organization has available for you to assess the performance of the company on a timely basis? Do you feel that your reports are inadequate, partially adequate, adequate, or superb? Okay, let's lock all those answers in. Here you go, Brian, with the results.
There we go. Well, it's good that half of you feel like you have adequate reports. I would suggest that, that's a pretty high number compared to what I hear from most organizations, at least with the clients that we tend to deal with. And so, but that's good to see. I mean, partially adequate obviously means that there's a lot of room for improvement still, and inadequate would mean you have some issues there from a reporting standpoint. And so, Brandon, we just have a few minutes left here. We got a couple questions for Dan that I want to leave a few minutes for, but when margins are compressed, organizations obviously want better insight into the financial performance of the organization, to really help make sure that they're making good business decisions. How is P2 advising its customers who are looking to get better insights across the enterprise?
Absolutely. And I'll try to go quick. I know we're running short on time. This topic is near and dear to my heart. I started my career in data warehousing and business intelligence. I can talk for hours. I'm not going to do that. I'm going to keep it to 2 or 3 minutes. But I think a couple of things are key. And you've heard me say this, and this is the third time, integrating and bringing that data together in a central repository is key, and bring it together in your transactional systems. The data also, of course, needs to be correct. and it needs to be, you need to be able to access it in a usable format. And this is where I think a lot of companies and organizations stumble, because a lot of times they'll pick one. Well, hey, this is our solution. Everybody use this. And the reality is, data requirements and data consumption is different across companies. It's different within companies. It's different even within a team, to do their role and their job the best way possible. There are formatted reports to slice and dice, and my lights just went on, so I'm going to wave. I guess I'm not moving enough. But reports to slice and dice, Excel-based dashboards, drill down, exception reporting, which we're seeing a lot more of these days, predictive analytics, and multiple ways to publish and share. And so we seek to address all of these. We have tools, spreadsheet tools. In process automation, spreadsheet tools are bad. In reporting, spreadsheet tools are still very, very good and still very useful. We have query tools, certainly canned reports, business intelligence tools, data warehouse products. We are now providing streaming, so that's actually pretty new, where we're streaming the data, to the user on like a 2-second interval, or allowing customers to take third-party software and connect it via web service and get at the data as well, using an MDM solution or a different BI tool. So again, I think it's an exciting time. I see customers looking to take advantage of their data more and more. I've seen customers that are very mature in that, and they're doing exception reporting and analytics, and then we see some customers saying, "Hey, we just want to have better visibility across our organization." And so, loving this area, I'm excited to see that.
And I like that you've got a lot of options for how to do it. So it's moldable to the data and the comfort level of the individuals doing it. I think identifying what gets moved and what is prioritized goes back to that streamlining and evaluating where we have duplication of effort, where we're recompiling data and evaluating just all the key spreadsheets and the reporting that's done outside of the system to prioritize that and then decide where to start. And what should be visualized first. But I think that's helpful.
And Elisa, just real quick, what are your thoughts on, if people don't have the wherewithal at this point in time, or, we're trying to remain disciplined with our spending, we don't have the ability necessarily to go procure, business intelligence solutions and so forth. What are some of the other low-cost methods you've seen people get better information through their systems?
So first, I'd say, look at the BI, the business intelligence reporting capabilities that are natural in your critical application. If you're using a P2 system, look at what you've already embedded for those reporting queries that can be repeatable. Absent that, I do think Excel and Power BI are also very great tools. If you're a Microsoft user, then your Microsoft suite comes with Excel, which we all know well, but one step further is the Power BI application, and it just takes it's like Excel on steroids, right? And if you've got an application that feeds directly, and I think you talked about the interplay with spreadsheets, Brandon, if it feeds directly, especially if you can attach directly to the data and recompile and refresh those configurations, the scripts that you've got in Excel or Power BI, then you've got it glued together and you've reduced that rework that maybe existed previously, where you're having to manually create the reporting. But yeah, Microsoft Suite definitely offers some very robust business intelligence reporting, data analytics reporting and capabilities without having to go procure another application or another report writer.
Yeah, that's absolutely, and in a low-cost way. Most people have Microsoft Office anyway.
Right.
And we recognize that we use it here at P2 as well for internal reporting. And that is why we built web services and we built the data warehouses that you can put whatever BI tool you want on top of that, including Power BI. Power BI has the intelligence to look at your table structure and actually make those connections, and you're off and writing queries immediately. And so we wanted to enable customers to be able to use the tools that they have at hand to get at their data.
Well, Brandon and Elise, I really appreciate all of your insights on different measures that organizations can be taking to make themselves more resilient through, these market conditions, through the streamlining, cost-cutting measures, and also, getting better data out of your systems. And so with that, I'm going to transition real quick. There was a couple of questions that came up that were directed to Dan that are really kind of getting more at, Dan, how does the change, obviously, in administration and the focus of this administration on green initiatives, how has that really affected the modeling that you've been doing as far as, what that's going to do either to demand or to supply? And if you had a 3 or 4 minute response on that, just appreciate getting your insights.
Bet I can do it faster than 3 or 4 minutes. So I think the Biden administration is clearly going to support lower carbon initiatives. And one of the ways, so that in and of itself, you should be indifferent as the oil and gas business, because we're kind of in a need it all scenario right now anyway. We need, here in Texas, we know we need power from all different sources because we didn't have enough when it got cold in February. But I think one of the challenges is that it's not just supporting green initiatives. There's a function of, well, maybe they're going to try and pay for part of that by penalizing the existing oil and gas business. There's a discussion around removing incentives. What are those incentives? Things like intangible drilling credits and things like that. So I think that there's 2 ways that this is mattering. You may get punished as the oil and gas business by the administration. And the other piece of it is everything that's going on, it is pulling capital away from the traditional oil and gas business. And so all the green stuff, I use stuff in air quotes, all the green initiatives, whether they're government or it's pulling companies into that as well. BP is going to take half their capital by 2030 and apply it to renewable and kind of green initiatives. So I think that there's a bit of a capital starvation issue. I think there's a bit of a potential for punishment or taxation or something. And, the industry is going to do what it's always done, which is you deal with that. And so I don't think we necessarily view what's happening on green initiatives as a negative, because I think it's part of what people want, right? Voters have said they want it and they'll pay for it partially. And so there may be some penalties. We're going to have to work around that. It probably implies the cost of doing business going up, which means the price of commodities probably going up. But at the end of the day, I think the other piece the industry has to do is it has to recognize the reality of operating more efficiently, safely, friendly, green, et cetera. And so you're seeing those ESG initiatives really take hold at energy companies as they should. So I lied. I think it did take 3 minutes, but that's what I think the implications of the new administration are. But it's not just the administration. It's the mindset of the world. And that's important. It isn't just the government, because Amazon's pushing it and BMW's pushing it and Ford's pushing it. It's happening everywhere because at the end of the day, people want a better planet, and I think that's the way to get there.
Thank you, Dan, for answering that question. And I really want to thank all 3 of you, Dan, Elisa, and Brandon. I really appreciate the insights you guys have provided and the expertise you brought to the table. So thank you very much.
Thanks to you, Ryan, Lisa, Brandon.
Lori, do you have any final housekeeping requirements?
Of course I do. So some final reminders for those of you who are attending for CPE credit. Right after our event, you will be asked to share or complete a short survey. Please take a moment to provide us with your feedback. Not only is it required for your CPE credit, but we very much rely on this insight to help us evaluate the effectiveness of our webinars and also future topics. Once your survey is complete, your CPE certificates will be emailed in about 1 week. I welcome you to stay connected to Weaver on weaver.com and our events page. We always have webinars happening and exciting topics and exciting presenters. We look forward to seeing you at our next event. Thank you all and have a really great afternoon.
Thanks, guys.